If you trade the wheel or sell puts or strangles on margin, you are probably leaving money on the table by not using the capital that you have allocated to cash secure those puts. Today, I will show you how box spreads can increase 3 to 5% annualized return with no market risk if you do it correctly. So let me show you how you can do this. Margin accounts, they don't require the full cash to secure a position. You can open a short put position with usually the margin requirement is below 20% and sometimes even below 10%. What ends up happening is that you still need to cash secure that position, or at least you should, but that money is just idle in there. Most traders will just leave the cash sitting idle, and while your broker might pay you something as a market return for that cash, it's usually a very low amount. For example, Interactive Brokers pays about 2%. It increases for larger accounts, but for small accounts, it's less than 2%. A box spread is a way that you can park that cash and earn a fixed return while keeping it available, and you can always close the box spread and get quick access to that money once again. So let me explain to you how this works. So how do you start a box spread? Well, first you start by buying a bullish call spread. In this case, I'm going to select to buy the 66.50s and sell the 70s. If I buy the 66.50s for $273 and I sell the 70s for $50.63, the total debit that I'm paying is $223.15. The max return I have is the width of the strikes, so that is $350. And this is the example of the trade that I put on SPX for February 20th. So that is 30 days out. Today is January 21st. And you can see I'm selecting SPX because it is critical that we select liquid options and European options. Liquid options because you want to trade at a fair value and you want to be able to close if necessary. And European options is critical because American options have the risk of assignment. If you get assigned on this trade, it will break your structure and then you have overnight risk. So please choose European options, and I always select SPX as part since it is the most liquid European option product. So as a second step, what we're going to do is then we're going to sell a bear put spread. You have to select the same strikes, and essentially you are getting the inverse position here. So you buy the 70s and you sell the 66.50s. The debit in this case is $125.85. The max return is the same, the width of the strikes, $350. When we put these two together, and you can see here at the bottom the exact position I opened yesterday, you have the debit of the bull call spread plus the debit of the bear put spread. It totals a debit of $349. As the max return is the width of the strikes, $350, you can see that we are locking in a profit. How does it lock in a profit? Well, if the SPY goes down, then your bear put will return the max profit. If it goes up, then your bullish call spread will return the max profit. If it's somewhere in between, you'll get a proportional amount of loss on one and win on the other. So you are essentially just guaranteeing a profit that is the same no matter what it closes at. You are guaranteeing in this case $100 of return, $1 350 minus 349 times 100 shares in an option contract. That gives you about 0.28% per month or about 3.43% per year. So essentially, box spreads give you a fixed profit that is the width of the strikes minus the debit that you paid to enter it. In the case of my example, $100. Essentially what is happening is you are working as a lender to the market. You are giving liquidity to the market and someone is taking that loan from you. As part of that loan, they are paying you interest that is slightly above the market free rate. Market free rate right now is about 3%, and you can get about 3.5 to up to 4% if you go to larger days to expiration. How you select how much you want to lend? Well, that's essentially selected by your strikes. If you want to lend 10K, then you want to have strikes that are $100 apart. If you want to lend 30K, then select strikes that are $300 apart. And lastly, use European options only. American options have the assignment risk as mentioned, so avoid them. I always use SPX for my box spreads. So how do I incorporate box spreads into my strategy? Well, when you sell puts, when you sell strangles, they usually are 30 to 45 days out, and you need to keep the capital to secure them. But you do not need to put it down at your broker since you are running a margin account. So at that time, I tie them up at the same expirations. Let's say I'm using the monthly expiration of 20th Feb, then I'm going to sell my box spread also for 20th Feb. And the idea is that the box spread and your short positions will expire at the same time, and they will free up capital to deploy new positions. So let me show you exactly how to do this using Interactive Brokers platform. So here we are in Interactive Brokers platform. I have selected SPX as mentioned, European options for S&P 500, and I'm going to show you an example where I want to lend 10K to the market, and I'm going to build a box spread around it. Since I'm going to lend 10K, what I'm going to do is to select strikes that are $100 apart. So I will start with the put side, and I'm going to buy the 68.50s, and I'm going to sell the 67.50s. So essentially this is my bearish put spread. Now I'm going to make the respective bullish call spread position by buying the 67.50s and selling the 68.50s. And you can see that Interactive Brokers automatically recognize this as a box spread, and then you have to select the price you are willing to pay for that box spread, and keep in mind that the max return that you can have out of it is 10K or 100 here. As such, you never want to pay more than 100 or 10K, otherwise you are locking in a loss. The price you lock in, let's say I can get this trade in for 19, let's say I can get this trade in for 99.55. The price I'm locking in is I'm getting a profit of $45 over the next. So that's it. These are box spreads. Box spreads aren't a trading strategy. They're a tool to maximize your returns, mainly when put together with short puts or strangles. If you're already selling puts on margin, this can give you an extra 3 to 4% annualized returns yearly, what really piles up over the long run. Best way to increase your returns in the long run. So what percentage of your account do you have sitting in cash? Let me know in the comments below. And if this was helpful, then please subscribe and like. And I'm documenting a whole journey trading a $50,000 account, so check it out if you are interested. Thank you.